It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Well, hello there. Welcome back to another fabulous stock market podcast, Trading Stocks Made Easy. Tyrone Jackson, the wealthy investor, but you know that. Hey, listen, in this episode, I wanted to talk about something I realized when we looked back I had never discussed. How to make money when stocks are dropping. Or, to put it in stock market terms, how to make money in a bear market. You see, most people, when they first start learning how to trade and or invest in the stock market, we think of the stock market as something that always rises. And most of the time, it does. Now, you know, in a wealthy investor program, for example, we don't trade things like penny stocks, stocks under $6, $5, $12. We stay with the bigger names. And in stock market terms, we refer to those bigger names as widely held stocks. Stocks that are members of the Dow Jones Industrial Average, the major index, and the S&P 500, another major index, are stocks in which we tend to trade with the greatest frequency. Why? A lot of people always say, hey, Tyrone, if you had to just explain it to me in a few words, what makes a stock price rise? And I always say demand. But what causes demand? Something called revenue and earnings. Revenue and earnings. Now, if you've listened to the podcast a lot, you know we only buy stocks or we only date stocks where the revenues are rising. Why? Rising revenues tend to attract institutional investors. Whereas you and I might buy 100 shares, 200 shares, or 2,000 shares, the institutions on Wall Street buy in million share lots. Now, a lot of people, when they're first learning about the stock market, go, there are companies out there that actually buy 1 million shares at a pop? The answer is, sure there are. Those institutional investors raise their money or get their funding source from either pension funds, 401ks, private institutional money, or these days we have a lot of hedge funds that take money from high net worth individuals and they put that money to work in the stock market. It's really that institutional money that moves the stock price higher, not you and I buying 200 or 2,000 shares. So when institutions are all attracted to the same stock, it is going to go higher. Now, without making it too complicated, when you hear me talking about institutional investors, I'm not just talking about institutions from the United States. I'm talking about institutions that are in Europe, Japan, all over Asia, all over the world, all trading in the U.S. stock market on any given day. That is an awful lot of money flow. Now, when earnings and revenues are really good, all of these institutions are rushing in to buy their favorite widely held stocks that are members of the Dow Jones Industrial Average and the S&P 500. If something should happen in the stock market that causes an adverse reaction, all of the institutions will leave at the same time. You've heard me talk about this before. How do they do it? By using something called a stop loss order, right? So if they buy XYZ stock at, let's say, $62 a share, it's gone up to $80 a share, they will stop out if something bad happens in the stock market at around 70. In at 62, stock is up at 80, my stop is at 70. Why is my stop loss at 70? Because if something adverse happens, I want to protect the profits, the difference between 62 and the 70. I want to lock those profits in. Now, not every institution is stopping out. Some institutions believe in holding stocks no matter what for a 5-year period before they can determine whether they'd like to sell their shares or not. However, institutional traders are the ones who normally stop out. So if they're all stopping out because something is happening in the world, a policy, an economic crisis, the Federal Reserve raising interest rates, if they're all stopping out, no matter how much homework you and I do, we're going to stay in the stocks that they're stopping out of. Are there ways to make money when the institutions stop out or when the market pulls back? And the answer is yes. Now, I normally wouldn't talk about stock market pullbacks on a podcast, but the fact of the matter is they are a reality. So right before I talk about what trades can help you when the market pulls back and institutional traders sell off temporarily, I want to make sure that you are familiar with some of the terminology that we use in the regular basis in the stock market. Now, just as an aside, in the Wealthy Investor Program, you hear me say all the time, we don't marry stocks, we date them, right? That means we're not going to buy a stock, fall in love, and just keep buying more and more and more unless the stock continues to rise. And those of you who are in the Wealthy Investor Program already have a membership at WI Trade School. You hear me use this terminology all the time, which is a buy signal. So what makes my program really successful in the methodology that I created helps my students make so much money because we never overbuy one particular stock. We wait for something called a buy signal. Now, there are several different buy signals, but the one that I talk about the most in the program is usually the $5 buy signal. In other words, if I like a stock and I go and I buy, let's say, 200 shares and I'm investing, I would never buy more than 200 shares at a pop. I'd wait for the stock to rise, and then I would go out and buy additional shares after that stock has increased $5. You see, I like for stocks to actually rise, to come to me to prove that they are worthy of future investment dollars. Now, when you're trading or particularly investing outside of discipline, you're just going for, I think the stock is going to go higher. You're totally wrapped up in your emotions. You've not calmed down or matured to the point where you realize to build a long-term portfolio, you let stocks come to you. You let them rise, and they will in effect say to you, hey, Tyrone, I am worthy of more of your investment dollars. All of this takes discipline. So, Wall Street terminology. Here we go. Are you ready? When a stock is rising or when markets are rising, in Wall Street terms, we refer to the stock or the stock market as being bullish. On Wall Street, bulls represent aggression. So therefore, a bullish market is one where almost every major stock or widely held stock is rising. When the market overall, the indexes are dropping and institutional traders are stopping out, we refer to the stock market as being bearish. Why? On Wall Street, bears represent retreat, right? Bulls for aggression, bears for retreat. Now, I usually don't talk about this unless I'm teaching higher end option strategies, but I'll go ahead and kind of fill you in on a few terms right now. I can be long-term bullish on the market and short-term bearish. I can simultaneously be long-term bullish and short-term bullish. When I'm bullish, that means I think the stock or the market will continue to rise over time. That's if I'm long-term bullish. If I'm short-term bullish, let's say the next 90 days, I think the stock and the stock market could rise, but only for the next 90 days. If you've ever listened to sophisticated analysts, they'll always talk about something called their outlook. And then the commentator will usually go, are you long-term bullish or short-term bullish? And then they will explain, well, in the long term, I think the stock will go higher. However, during the Christmas holidays, I'm bearish on the stock. I don't think it's really going to rise. Okay? So we've got the bull and bear terminology. It's very specific to your feeling, which we call on Wall Street sentiment. So I am long-term bullish on any stock that I purchase. I am also short-term bullish pretty much on any stock that I purchase, but that doesn't mean that I'm always going to be right. When the stock that I am long-term bullish on pulls back, some people become short-term bears in that stock, meaning for a 90-day period, a 120-day period, a 30-day period, they think because of something that's going on in the market or the company makes an announcement that in the short term, the stock is actually going to pull back. And it does happen. If you pull up a 5-year chart of any company, pretty much any company, it's had a period where it ran up, it pulled back $2 to $5, it rested, and then it started to rise again. And when a stock starts to rise after it's pulled back, that's called retracement. Now, I know I'm hitting you with a lot of terms here, but one of the things I always say to you on this podcast is you must have a financial education if you're going to be a successful trader and investor in the stock market. This all has something to do with how to make money when a stock pulls back, so just be patient and I'll get you there. Okay, so if I'm bullish on all the stocks that I actually own, it doesn't mean they're going to go straight up. Most stocks don't. They pause a little bit or they pull back, and they may become bearish, or I may become bearish for a short term. Here's what I want you to remember. When markets rise, we use covered calls to generate weekly and monthly income. What kind of covered calls do we sell? Generally, when the market is bullish, we're selling out of the money covered calls. Although I've been teaching a lot of my students when the market is bullish to sell in the money covered calls for something called downside protection. Okay? But you can just think of it this way. Market bullish, covered calls in and out of the money. When the market is neutral, covered calls in and out of the money will generate income depending upon your perspective. So short term, if the market is not moving, if I'm selling the out of the money covered call, I'm doing it taking the income. If I'm selling the in the money call, I'm doing it to get rid of the stock while the stock is actually in neutral mode. Okay? So we've got bull, bear, neutral, and covered calls, which we use in almost every single market set of circumstances. But when we hit a period where the entire market seems to be pulling back, what do we do? Is there a way when stocks are actually dropping that you can make money? The answer is yes, and it's called spreads. What kind of spreads do I like when the market is pulling back? I like something called bear call spreads. Now, how can bear call spreads produce thousands of dollars when the market is pulling back? Well, that I'm going to explain to you right after you take a listen to this.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't know which stocks to choose for trading in today's market? No problem. Just follow Tyrone Jackson's hot stock picks inside WITradeschool.com. At WITradeschool.com, you could also follow Tyrone's weekly stock market tutorials and investing advice. Plus, each week you can submit your trading and investing questions directly to our staff, and Tyrone will answer them as part of our weekly video Q&A sessions. Begin your membership right now and you'll get instant access to WITradeschool.com's video library. That means you'll get to know all of Tyrone's major and minor trading strategies, including covered call writing and volatility trading for fast, sexy profits. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. In addition to his successful podcast, Tyrone's editorial content has been featured on CBSMoneyWatch.com, NASDAQ.com, and YahooFinance.com. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
You're listening to the Trading Stocks Made Easy podcast. Want to learn more about how to trade and invest in the stock market? Visit thewealthyinvestor.net/products. That's thewealthyinvestor.net/products and order the Wealthy Investor's Guide to Stock Market Success audio series. This easy-to-follow 5-CD audio series and manual will teach you the basics of how to buy and sell stocks, how to collect quarterly dividends for life, plus hidden income generating strategies like covered call writing and volatility trading. Start creating financial freedom right now. Get the financial education you need to get ahead. Visit thewealthyinvestor.net/products.
Welcome back. Now, right before the break, we were talking about this idea of covered calls in a bull market environment, in a neutral market environment. But I asked you the question right before the commercial, how would you make money using spreads? Well, right before I get to spreads, there's another way that you can profit when stocks are pulling back, and those are called put options. Now, a put option is the right to make money essentially off of the stock as it drops. It can also be defined a lot of other ways, but imagine when a stock goes down, if you own a put option, as the stock is going down, the put option is actually increasing in value. Now, there are longer dated puts, known as leaps, or shorter dated puts that are just options. This combination of long and short puts when the market pulls back can be used to make money. However, most of my students don't do that well. Why? Because when their favorite stock is dropping, they start rooting for the stock to really go down so they can make money on the put side. And that works, but you have to be highly skilled. What I have found is spreads work better than puts because no one knows how far down a stock is going to go when it drops if the earnings are strong. So if the earnings are strong on this widely held Dow component on S&P stock, don't ever bet against that stock for a longer period of time. Because very often in a sell-off, the thing that's causing the stock to sell off has nothing to do with the stock. It could be the Fed, as I said before, raising interest rates. That's why I like spreads. A spread allows you to collect income without owning the stock initially. I'll say that again. A spread allows you to collect income without owning the stock initially. So did you know that there's a way to make money using options, not necessarily put options, although it could be, to generate profit when a stock is actually in decline? What kind of spread is that? It is a bear call spread. Now, what a bear call spread does, it allows you to buy one option and sell another option against it. To be more specific, you're buying one out of the money option and selling another out of the money option against it. The way that I like to teach the bear call spread is so that you always make 300% on your money without owning the stock initially. Now that's pretty exciting, right? I really only teach bear call spreads at the upper levels of the program. For those of you who are in the mentor program, you know what I mean. Bear call spread is the one trade that once you master it, it's very difficult to lose money. But it takes quite a bit of study to get used to selling one option against the other. Or if we were going to put it in Wall Street terms, you'd be selling one derivative against a derivative. So think of it this way. If I could teach you how to make 300% on a particular trade, not your entire account, on a particular trade, would that be worth learning about? Yes, it is a higher level of education because now you are trading rights/derivatives against shares. What I have found is institutional traders who do this every single day, who sit behind a computer screen every single day, get really good at being derivative traders, especially when the market is bearish. But if you're a trader who's only been good when stocks are actually rising, you're going to have a problem when your favorite stock drops. You work really hard for the money you put in your trading account. Your job is to not lose it. Therefore, if you have any interest in making money when stocks rise, you want to learn how to do that. But your next interest must be learning how to profit when stocks decline. Why? There's a wonderful saying on Wall Street, stocks actually decline faster than they rise. That means you and I can be using the bear call spread when something dramatic happens in the market and stocks are declining because we're selling rights against rights instead of just owning shares. Now, the bear call spread, like I said, is one. The way that I teach it is for a 300% return. So what does that mean? You would take $1,000 and turn it into what? $3,000 or $4,000 while stocks are declining, depending upon what methodology you actually use. So it took me several years to develop a methodology that was reliable, that would help people. So let's just do a little recapping. As the markets are rising, as they do most of the time, I'd say 95% of the time, the stock market is actually rising. But on those occasions when they don't, what are you going to do to make money? You're going to stop selling cover calls and you're going to convert into bear call spreads. So, as I often say in this program, your wealth is in your thinking. It's in your belief systems. Now, I know that there's some of you listening right now going, I knew there was a way to make money when stocks actually dropped. I just didn't know how to do it. Okay? All right. So as we move forward here, I am now going to teach you, for those of you who venture to join WI Trade School, eventually I'm going to teach you how to make money when stocks rise, cover calls, volatility in and out of the money. And when stocks pull back using bear call spreads, I'll show you how it works on longer dated puts, but most of my students aren't really good at that. They're better at setting up spreads once they learn what they are. Now, I just want you to know that my webinar on how to trade when stocks are going down is just around the corner. So here's where you want to go. If you want to just be on the live webinar and you want to see examples of how to make money when stocks go down, I'll be explaining it to you. All you have to do is go to this URL, thewealthyinvestor.net/bear market. I'll say it again, thewealthyinvestor.net/bear market, and opt in, and you can be on the next live webinar learning exactly what most people don't know, which is how to make money when stocks decline. Is that exciting or what? So I want you on that webinar. It's absolutely fascinating. When I first learned how to profit when stocks were declining, I was hit with a case of because it felt so good to know that I was empowered with the knowledge to make money regardless of market direction. So I'm going to tell you a really quick story. I was invited to speak at a very, very large trading conference. And, it's one of those places where you actually have a booth and then you go before the audience and you do your presentation. And it's a great way to meet a lot of people, not only in the industry, but also a lot of traders. So I'm standing at the Wealthy Investor booth at this particular event, and a woman comes up to me and she goes, "My husband just got our trading account over $1 million. I said, "Are you kidding me?" I said, "You tell your husband to come over and actually meet with me because I'd love to meet him." So he comes over about an hour later. He goes, "My wife says you wanted to meet me." I said, "Yes. What's your strategy for getting your account over $1 million? There's a bunch of them." And he goes, "Tyrone, I do it all through spreads." I said, "What kind of spread?" He goes, "Bear call spreads." Now, just between you and I, bear call spreads also work when the market is bullish, but you have to really be good at them. So he comes over and he says, "Yes, I use bear call spreads." And I said, "What?" He goes, "On this particular ETF, and I trade very large contract sizes." I was like, wow, that's great. So we got into like deltas on options and in and out of the money options and time decay and the whole thing. And I was so happy for this guy. And he says, I use ETFs because I really don't like stocks. I personally really do like stocks, and I can get the same result that he gets from the ETF, but he feels comfortable with that. So I said, "Well, what do you do now?" He goes, "I'm going for $2 million. And I gave him a thumbs up. We shared a great laugh because this guy was on his way because he wasn't worried about market direction. He was constantly pulling in income, setting up spreads. Now, I'm not telling you if you come to the webinar, you too are going to make $1 million that quickly. I'm just saying that there are people out there who actually use a bearish strategy under any market conditions to do well. Why? Because trading in the stock market is all about your financial education. Your mindset, your thinking, your beliefs about what is possible. And of course, that financial education is what the Wealthy Investor Program is all about. All right, my time is almost up here, but I want you to really head on over right now to thewealthyinvestor.net/bear market. Be on the next live webinar with me, and you'll know something that most traders don't know, which is how to profit under any market condition, but certainly when the market is in decline. Hey, that's going to do it for me, Tyrone Jackson, the Wealthy Investor, saying thank you so much for being here. Stay open, stay positive, and pursue with passion that financial education. I'll see you next time.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the Wealthy Investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.